As the U.S. stock market is currently closed for the weekend, SoundHound Ai, trading under the ticker SOUN, finished Friday's session on October 3, 2025, at a closing price of $17.85. It was a volatile day of trading, with the stock swinging between a high of $19.10 and a low of $17.29, before settling near the bottom of its daily range on volume of nearly 75 million shares. That closing price represents a fractional gain, but the real story isn't in that day-end figure. The expectation in the market, particularly among retail investors using platforms like the Robinhood app for their online investing, is that SoundHound Ai is on an unstoppable ascent, fueled by headline-grabbing partnerships and the tailwind of the entire artificial intelligence sector. The deeper reality, however, is that this company is walking a precarious tightrope between explosive top-line growth and staggering operational cash burn, a tension that the intraday volatility starkly reflects. The narrative says this is a simple AI play, a direct beneficiary of investment from giants like NVIDIA stock. The truth is that its fate is tied to a complex web of customer concentration, intense competition, and a desperate race towards profitability that is far from guaranteed. The common belief you'll find circulating on forums and social media is straightforward. SoundHound is the definitive voice of the future. Its technology is being integrated into everything from Stellantis and Hyundai vehicles to fast food drive-thrus. This creates a compelling and easily digestible story of inevitable market domination. Investors see the name, they see the partnerships, and they assume a linear path upwards. This is the expectation that has propelled the stock over 200% in the last year. But this perspective misses the critical undercurrents that institutional players, those managing large fidelity mutual funds or executing complex trades through interactive brokers, are watching with extreme caution. The reality is that while revenue growth has been astronomical, recently posting a 217% year-over-year increase to $42.7 million in its latest quarter, the company's net losses are equally eye-watering. The net profit margin stands at a deeply negative 171%. This isn't just a company reinvesting for growth. It's a company burning through cash at a ferocious rate, betting that it can achieve scale before it needs to return to the capital markets, potentially diluting existing shareholders. For anyone engaging in self-investing, understanding this cash burn relative to its remaining runway is absolutely critical. Looking at the recent stock movement provides a clearer picture of this battle between expectation and reality. The stock's beta of 2.6 indicates it is significantly more volatile than the broader market. In the past few months, we have seen massive swings. Following its last earnings report in early August, where it beat revenue expectations but missed badly on earnings per share, the stock initially surged before giving back a substantial portion of those gains. This is a classic sign of a market struggling to price a company correctly. The revenue beat feeds the bullish narrative, while the earnings miss confirms the bearish fears about profitability. Trading volume often spikes dramatically on news, whether it's a new partnership announcement or insider selling disclosures. Recently, several top executives, including the CFO and CTO, sold shares under pre-scheduled 10b5-1 plans. While the company frames this as routine, it invariably spooks a segment of the market, contributing to downward pressure. Institutional ownership sits around 42%, with major players like Vanguard and BlackRock holding significant stakes. Their presence provides a degree of stability and credibility. However, it's worth noting that some wealth management firms have recently trimmed their positions, a subtle signal that the professional community is perhaps taking some profits off the table after the stock's massive run-up. The price action is not just a reflection of SoundHound's performance, but is also heavily influenced by the broader sentiment on AI and growth stocks, making it a proxy for the market's overall risk appetite. For an investor using a service like SoFi Invest, which offers both active and robo-advisory services, a stock like SOUN presents a significant challenge in portfolio allocation due to this extreme volatility. So, what does SoundHound AI actually do? At its core, it develops advanced, independent voice artificial intelligence and conversational intelligence technologies. The company operates through two main platforms. The first is its namesake SoundHound music identification app, which competes with services like Shazam. The second, and far more critical to its valuation, is the Houndify platform. This is what powers the conversational AI in cars, customer service centers, and restaurants. The business model is multifaceted, relying on a mix of licensing fees, subscription services, and revenue-sharing agreements where they take a small piece of each transaction their AI facilitates, for instance, a food order placed through a drive-through kiosk. This transaction-based model is particularly appealing because it allows SoundHound to grow alongside its customers. The more orders processed, the more revenue it generates. This is a key part of the bull thesis and a reason why many believe its growth can continue at an exponential rate. The company boasts an impressive backlog of over $1 billion in cumulative bookings, which gives some visibility into future revenues. The recent acquisition of Amelia, a conversational AI platform, and Interactions, another customer service AI firm, signals a clear strategy to consolidate its position in the enterprise market, moving beyond just voice recognition to creating full-fledged AI agents that can handle complex end-to-end customer interactions. Platforms like Fidelity Investments offer extensive research tools that can help investors dissect these acquisitions and their potential impact on future earnings and synergies. Looking ahead, the future of SoundHound AI presents a landscape of significant opportunities balanced by substantial risks. The primary catalyst is the continued adoption of AI in customer-facing roles. The market for agentic AI, digital employees that can autonomously resolve issues, is projected to be worth trillions of dollars. SoundHound, with its new acquisitions in advanced tech, is positioning itself to be a pure-play leader in the space. Securing another major automotive client or a large-scale deployment with a global restaurant chain could be a massive catalyst for the stock. Furthermore, management has guided for adjusted EBITDA profitability by the end of 2025. If they achieve this milestone, it would fundamentally alter the investment narrative from a speculative growth story to one of a profitable high-growth tech company, which could attract a new class of investors and significantly re-rate the stock upwards. Those using diversified tools like Schwab Intelligent Portfolios might see a company like SOUN added to their holdings only after it demonstrates a clear path to sustainable profit. However, the risks are just as pronounced. The most significant is the immense competition. While SoundHound is a leader, it operates in a space where tech giants with nearly unlimited resources, such as Google, Amazon, and Apple, are also heavily invested. These giants can afford to operate their voice AI divisions at a loss for years to gain market share, a luxury SoundHound does not have. There is also a considerable customer concentration risk. While the company has made strides in diversifying its revenue, the loss of a key client in the automotive or restaurant sector would still be a major blow to both its revenue and investor confidence. The company's valuation is another point of concern. Trading at over 50 times trailing sales, the stock is priced for perfection. Any execution misstep, any delay in achieving profitability, or any sign of slowing growth could lead to a severe correction, similar to what was seen in the broader tech sell-off in 2022, where the stock was decimated. Given these factors, I want you to comment below. Do you believe SoundHound's technology is sufficiently differentiated to fend off competition from big tech in the long run? In conclusion, the story of SoundHound AI is a fascinating case study in the tension between a powerful market narrative and a complex financial reality. The expectation, held by many who trade on platforms like Robinhood or SoFi, is that of a company on a clear and inevitable path to becoming an AI behemoth, a smaller version of an Nvidia stock or Apple stock in the making. The reality, visible in its financials and the stock's wild volatility, is that of a company in a high-stakes race against time. It must convert its impressive technology and massive revenue growth into actual, sustainable profit before its cash reserves dwindle or its competitors overwhelm it. While the partnerships are real and the technology is powerful, the path forward is but anything uncertain. Investors using a Fidelity brokerage account or a sophisticated platform like Interactive Brokers need to look beyond the exciting headlines and analyze the burn rate, the competitive landscape, and the immense valuation risk. The expectation paints a picture of a rocket ship, but the reality is that this is a highly speculative investment where both extraordinary gains and substantial losses are distinct possibilities.